Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 16th of July. I'm Daniel Lam, your host for the podcast. Today is a very significant date for me as my son turned 6 years old. And also, he had his final day of kindergarten yesterday. So, a day to remember. Well, in the financial world, it was also quite noteworthy overnight that the US CPI inflation figure finally went above expectations. This number was important because some people have been feeling that inflation from tariff was just, quote-unquote, a crying wolf. Headline inflation came in above expectations at 2.7% year over year, while core matched estimates at 2.9%. Now, core goods inflation picked up on rising prices in tariff-exposed areas like furnishings, apparel, and recreation commodities, partially offset by falling vehicle prices, but we believe that offset will be fading in the coming months. Now, companies could also be delaying tariff-related price hikes, suggesting that further goods inflation is in the horizon. However, core services inflation is on a downtrend, and slowing labor market should limit upward pressure on broader inflation. For now, price increases remain confined to tariff-affected sectors. Now, the S&P 500 and Nasdaq 100 indices started the day at its high, only to close at the day low. I want to point out that many investors will be looking at the headline one-day return of S&P 500, which was down 40 basis points, and saying that it was only a small drop. But it is actually very important to be looking at the intraday move. Starting the day at the highs and ending at the lows is negative. Even more so when the index opened at the all-time high at 6,304 and came back down with high volume versus the previous days, suggesting that sellers are coming in at the highs. Also remember that I always look at the relative strength indicator, i.e. the RSI, and compare that against the actual index level. The index, like I said, made a high, but the RSI has been coming off gradually over the last 7 sessions. That means the index is lacking the strength to go higher from here and is due for consolidation, something that we've been pointing out in our publications. So we reiterate that investors should be trimming excessive long positions in US equities into strength. Now, where can US equities go to? Well, the first level of support for the S&P 500 is at 5,950, followed by 5,767. Watching the technical levels is actually very important now because many of the trend-following funds have been driving this leg of the rally, starting from roughly the end of June. If we break key support levels, then it can exacerbate this correction. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.